Chapter 10, Current Liabilities and Payroll. When a company or a bank advances credit, they're making a loan. The company or bank is called a creditor or a lender. So whoever is making the loan, that's the creditor, or also known as a lender, depending on how you're referring, what type of lender you're referring to, creditor. The individuals or companies receiving the loans are called debtors or borrowers. So if we borrow money to buy a house, we have a lender who's lending us the money, and we are the borrower. Debt is recorded as a liability by the debtor. Long-term liabilities are debts that are due longer than 1 year, and short-term is anything due within a year. Short-term, also known as current. So current liabilities are debts that will be paid out of our current assets and are due within 1 year. Accounts payable transactions involve a variety of purchases on account, including the purchase of merchandise and supplies. For most companies, accounts payable is the largest current liability account that they have. Long-term liabilities are often paid back in periodic payments called installments, and such installments that are due within the coming year are classified as current liability, and the installments that are due after the coming year are classified as a long-term liability. So if you think of a house, or if a business owns a building and they've purchased, they still owe 6 years on the building. That first year of the building is always going to be considered current, and the following years are going to be considered long-term. So notes may be issued to purchase merchandise or other assets. Notes may also be issued to creditors to satisfy an account payable created earlier. The entry to record the issuance of the note debits accounts payable and credits notes payable. So the journal entry that you would use to record the issuance of a note, you would debit your accounts payable and credit your notes payable accounts. Each note transaction affects a debtor and a creditor. So here we have a couple of examples. On May 1st, Bowden Company purchased merchandise on account from Coker Company of $10,000, and their payment terms were $210 net 30. The merchandise cost Coker $7,500. So on Bowden's books, the borrower's books, they are going to record a debit to merchandise inventory for the full amount of $10,000, and they're going to credit their accounts payable account for the full amount of $10,000. For the creditor, Coker is going to debit their accounts receivable for $10,000 because that's what they are owed, and they're going to credit their sales account for $10,000. But they're also going to make this adjustment on their merchandise account. So they're going to debit their cost of merchandise sold for $7,500 because that's what it actually cost them. And they're going to credit their merchandise inventory account for $7,500. On May 31st, Bowden Company issued a 60-day 12% note for $10,000 to Coker Company on account. So Bowden Company, the borrower, They're going to debit their accounts payable for the full $10,000, the amount of the note. They're going to credit their notes payable account for $10,000 because they have a note payable for $10,000. The creditor, they have a note receivable. They are going to be receiving this note. So they have a debit to notes receivable for $10,000 and a credit to accounts receivable for $10,000. So you see here now their accounts receivable account is cleared out. For this particular transaction, because we debited our accounts receivable account here and we credited it here. So that note has cleared out our accounts receivable accounts for this transaction. So now we have a note receivable. And then in July 30th, Bowden Company paid Coker the amount due on the note, and the amount due on the note is not $10,000. We have a note for $10,000, but we see up here it's at a 12% interest rate. So when we pay the note, we also have to pay the interest. So we're going to take that $10,000 times our 12% interest rate times 60 days, because it's a 60-day note. And then we're going to divide that by 360, which is the number that they normally use for the days in the year. So that's how we come up with our interest expense. So when we pay Coker, when Bowden pays Coker, Bowden is going to debit their note payable, which is going to clear that out. So we had a credit here, now we have a debit here, so we've cleared out our note payable. But we also have our interest expense. So we have to debit our interest expense account, and we're going to credit all of that to cash. When Coker records this transaction on their books, Coker has received the $10,200 in cash, and they are going to credit their interest revenue account for the $200 because they made that revenue off that note, and they're going to credit the note receivable of $10,000, which that clears out their notes receivable account. A company may also borrow money from a bank by issuing a note. In this case, cash is debited and notes payable is credited. In some cases, a discounted note may be issued rather than an interest-bearing note. A discounted note has the following characteristics. With a discounted note, the interest rate on the note is called the discount rate. The amount of interest on the note, called the discount, is computed by multiplying the discount rate times the face value of the note. The debtor, also known as the borrower, receives the face value amount of the note minus whatever the discount is, called the proceeds. And the debtor must repay the face value amount of the note on the due date. In accounting, payroll refers to the amount paid to employees for services they provided during the period. A company's payroll is important for the following reasons. Payroll and related payroll taxes significantly affect the net income of most companies. Payroll is subject to federal and state regulations, and good employee morale requires payroll to be paid timely and accurately. No one wants to be paid late. Salary usually refers to payment for managerial and administrative services. Wages usually refer to payment for employee manual labor. The salary or wage of an employee may be increased by bonuses, commissions, profit sharing, or cost of living adjustments. Companies engaged in interstate commerce must follow the Fair Labor Standards Act, and this act, sometimes called the Federal Wage and Hour Law, requires employees to pay a minimum rate of 1.5 times the regular rate for all hours worked over 40 hours per week, time and a half. The total earnings of an employee for a payroll period, including any overtime pay, is called gross pay. From this amount is subtracted one or more deductions to arrive at net pay. So I know a lot of times people will ask me, well, in the past, people have asked me, what is my gross pay, or what is my net pay? Or you might be filling something out online, or I don't know, filling out a loan application to get a car or something. And sometimes they ask for your gross pay, sometimes they ask for your net pay, and people never know what that is. So just kind of like, I guess when you think about it, gross is everything. Gross is everything before you take out any deductions. And then your net pay is after you've subtracted out all of your deductions. It's what you're left with. Sometimes companies want to see your gross pay, which is literally your hourly pay times the number of hours you normally work. Other times they want to see what you take home, which is your net pay, your take home pay. So it just depends. But that's the difference. Know the difference between the two. Net pay is the amount paid to the employee. It's what they actually get deposited in their bank account, or when you go cash or check at the bank. The deductions normally include federal income taxes, state income taxes, local income taxes, medical insurance, pension contributions, any of those things. If you have a 401k, that your contribution would come out as well. So employers normally withhold a portion of employee earnings for payment of the employee's federal income tax. Each employee authorizes the amount to be withheld by completing an employee withholding allowance certificate, also known as a W-4. And on the W-4, an employee indicates their marital status and the number of withholding allowances. Each allowance reduces the federal income tax that's withheld from the employee's pay. So the more allowances you have, the less money they withhold from your pay. Withholding tables issued by the Internal Revenue Service, IRS, are used to determine the amounts to withhold, and each year the amount of standard withholding allowance is determined by the IRS. This can change, like the amount can change. After the person's withholding wage bracket has been computed, the federal income tax to be withheld is then determined. Employers are required by the Federal Insurance Contributions Act, also known as FICA, to withhold a portion of the earnings of each employee. You'll see FICA on your paycheck as well. The Fica Tax withheld contributes to 2 different federal programs. FICA goes towards your Social Security and also your Medicare. Social Security provides payments for retirees, survivors, and disability insurance. Medicare provides health insurance for senior citizens. Employees may choose to have additional amounts deducted from their gross pay, such as deductions for a retirement savings, 401k, charitable contributions. Some companies offer life insurance through the company, so you can have that deducted from your paycheck as well, if you choose to. Computing employee net pay. Your gross earnings, which we mentioned earlier, is everything before your deductions. Your gross earnings minus any payroll deductions equals your net pay. Net pay is sometimes called your take-home pay. Employers are subject to the following payroll taxes for amounts paid to their employees. So they're subject to Fica tax, federal unemployment compensation tax, and state unemployment compensation tax. Fica tax, employers must match the employee's Fica tax contribution. So anything that the employee contributes, the employer must also contribute to Fica. The federal unemployment compensation tax, also known as FUTA, so you might see that on your paycheck as well, FUTA. This employer tax provides for temporary payments to those who become unemployed, and the state unemployment compensation tax, SUTA, you can see that on there. This employer tax provides temporary payments to those who become unemployed. Payroll systems should be designed to pay employees accurately and timely. They must meet regulatory requirements of federal, state, and local agencies and provide useful data for management decision-making needs. Although payroll systems differ among companies, the major elements of most payroll systems are the payroll register, the employee's earnings record, and payroll checks. The payroll register is a multi-column report used for summarizing the data for each payroll period. So here we have a sample payroll register. So it says the column totals of the payroll register provide the basis for recording the journal entry for payroll, and the entry is based on a sample payroll register as follows. So on December 27th, we had sales salary expenses of $11,122, and then we had our office salary expenses of $2,780. So we debited both of those expenses for our salaries expense. And then we're going to credit our Social Security tax payable, our Medicare tax payable, employees' federal income tax payable, all of our payable accounts associated with payroll. And then our note is payroll for the week ended December 27th. Payroll taxes are recorded as liabilities when the payroll is paid to employees. In addition, employers compute and report payroll taxes on a calendar year basis, which may differ from the company's fiscal year. Employers must match the employee's Social Security and Medicare tax contributions. And in addition, the employer must pay state unemployment compensation, SUTA, of 5.4% and federal unemployment compensation, FUTA, of 0.8%. Each employee's earnings to date must be determined at the end of each payroll period. This total is necessary for computing the employee's Social Security tax withholding and the employer's payroll taxes. Thus, detailed payroll records must be kept for each employee. This record is called an employee's earnings record. The detailed payroll records, employee's earnings record. Most companies use a special payroll bank account to disperse payroll. Companies pay employees either by electronic funds transfer or by issuing payroll checks. With electronic funds transfers, the employee's net pay is electronically deposited into their bank account each period. Later, the employees receive a payroll statement that summarizes how their net pay was computed. Each payroll check, these are the paper checks. Each payroll check includes a detachable statement showing how the net pay was computed, which is typically identical to the payroll statement accompanying electronic funds transfers. The inputs into a payroll system may be classified as constants and variables. Constants, that's the data that remains unchanged, it's constant, so it remains unchanged from payroll to payroll. And some examples of that includes the employee's name, social security number, marital status, their rate of pay, and their tax rates. Yes, names can change with marriage and divorce, and rates of pay can change with raises, but for the most part, these things stay constant. It doesn't change every pay period, like if you get paid weekly every single week. So that's why those are considered constant. And then variables, this is data that changes from payroll to payroll. So every time you get paid, this can change. The number of hours that you worked, the days that you worked, how many days of sick leave you've accrued. So some companies will give you sick leave and you accrue that sick leave. You get that sick leave based on how long you've been there. So, or you may use your sick leave, and that would reduce the amount of sick leave that you have. And then your total earnings to date, that's going to change because every week that you get paid, you've earned a little bit more money, so that total earnings to date number would be increasing. Some examples of payroll controls include if a check signing machine is used. So if you have a machine that signs all of your checks for you, and blank payroll checks and access to the machine should be restricted to prevent theft or misuse. So you just want to make sure that you have limited access to the machine so that people aren't tempted to misuse it. The hiring and firing of employees should be properly authorized and approved in writing. All changes in pay rates should be properly authorized and approved in writing. Employees should be observed when arriving to work to verify that employees are checking in for work only once and only for themselves. Employees may check in for work by using a time card or swiping their employee ID card. Payroll checks should be distributed by someone other than the employee supervisors, and a special payroll bank account should be used. Many companies provide their employees benefits in addition to salary and wages, and those additional benefits they're called fringe benefits. They can include vacation pay, medical benefits, and retirement benefits. The cost of employee fringe benefits is recorded as an expense by the employer. A pension is a cash payment to retired employees. Pension rights are accrued by employees as they work based on the employer's pension plan. Two basic types of pension plans are defined contribution and defined benefit plan. In a defined contribution plan, the company invests contributions on behalf of the employee during the employee's working years. Normally, the employee and employer contribute to the plan. The employee's pension depends on the total contributions and the investment returns earned on those contributions, and the employer's cost is debited to the pension expense. In a defined benefit plan, the company pays the employee a fixed annual pension based on a formula. The formula is normally based on such factors as the employee's years of service, age, and past salary. The employer is obligated to pay for fund the employee's future pension benefits, and the pension cost of a defined benefit plan is debited to pension expense. Cash is credited for the amount contributed or funded by the employer, and any unfunded amount is credited to unfunded pension liability. Employees may earn rights to other post-retirement benefits from their employer. Such benefits may include dental care, eye care, medical care, life insurance, tuition assistance, tax services, legal services. Some companies, I know a company that I worked with before, they even offered services for like mental health and even substance abuse counseling and stuff like that. So just depends on the company. The estimate of the annual benefits expense is recorded by debiting post-retirement benefits expense. If the benefits are fully funded, cash is credited for the same amount. If the benefits are not fully funded, a post-retirement benefits plan liability account is also credited. The nature of post-retirement benefit liabilities should be disclosed on the financial statements, and these disclosures are usually included as notes to the financial statements. Some liabilities may arise from past transactions only if certain events occur in the future. These potential obligations are called contingent liabilities. The accounting for contingent liabilities depends on the following two factors: the likelihood of occurring and the measurement. So the likelihood that the event creating the liability occurring is classified as probable, reasonably possible, or remote. And then the measurement is the ability to estimate the potential liability is classified as estimatable or not estimatable. So how likely will this particular event occur? Is it highly likely that this is going to happen, or do we think it's probably, you know, we're going to kind of like think about it, but it's probably not going to happen. So the likelihood, and then can we, okay, we think this event's going to occur, how much will it cost if it happens? So can we estimate what that potential liability would be? Or we have no clue what this might possibly cost. Current position analysis helps creditors evaluate a company's ability to pay its current liabilities. This analysis is based on working capital, current ratio, and quick ratio. So current position analysis helps creditors evaluate a company's ability to pay its current liabilities. It's based on working capital, current ratio, and quick ratio. And we have here, you can see this on the slide, sorry. But for working capital, it's computed by, you take your current assets minus your current liabilities, and that gives you your working capital. And the current ratio, you're going to take current assets divided by current liabilities. So current assets divided by current liabilities gives you your current ratio. While these two measures can be used to a company's ability to pay its current liabilities, they do not provide insight into the company's ability to pay these liabilities within a short period of time. So we have a quick ratio. The quick ratio overcomes this limitation by measuring the instant debt-paying ability of a company. It is computed by taking your current assets divided by your current liabilities, and that's going to give you your quick ratio. Quick assets are cash and other current assets that can be easily converted to cash. A quick ratio below 1 indicates that the company does not have enough quick assets to cover its current liabilities. So below 1 is not good for your quick ratio. So we're going to work some practice problems. I'll give y'all just a few seconds to work through this one. It says on June 1st, Davis Incorporated issued an 84,000 5% 120-day note payable to Garcia Company. Assume that the fiscal year ends on June 30th. Using the 360-day year, what is the amount of interest revenue recognized by Garcia in the following year?
So tricky.
So the example that we did a few slides back, we didn't really do an example, but remember when we were reading through the bar and we were reading through those two slides with Coke and the other company, and we were looking at the note that they had taken out, and it had like a 12% interest rate. It was a 60-day note, and we used 360 days. We're going to solve this the same way. So to find the amount of revenue recognized by Garcia, we're going to take this 84,000 times 5%. We're going to multiply that by 120 because this one says it's a 120-day note. And then we're going to divide all of that by 360. Then we're going to multiply that by 120 minus 29. And that's going to give us, divide that by 120, and that's going to give us this 1062.
Yeah, so that fiscal year end, you don't even need, that's like irrelevant information. Because at first that was like throwing me off. I'm like, well, I guess you kind of do need it, right? If it's going on the 29th, is that why you have that minus 29? Like, is that supposed to be like the amount of days?
Days.
Yeah, so okay.
Yeah.
That would make sense.
All right. So for this next one, assume a 360-day year. The proceeds are 48,750, which were received from discounting a $50,000 note, and it was a 90-day note. So the discount rate used by the bank to compute the proceeds was, so we're trying to figure out what our discount rate is. So we have a $50,000 note. The proceeds from that note were 48,750, and it's a 90-day note. And we're trying to figure out what the discount rate is that they used for this note.
So we're trying to figure out how, like what the percentage is between that 48 and 50,000.
Yep.
Okay.
Mm-hmm. First, we want to figure out what was the amount of the discount. So how would we figure out the amount of the discount?
We would take the 48,000 right from the 50.
Mm-hmm. Yep. So the 50,000 minus the 48,000 is going to give us the amount of the discount.
And then we'll just divide that into the total of that 50,000, right? And that should give you the
Mm-hmm.
percentage.
So to find the discount amount, you take the 50,000 minus the 48,750, and that gives us this $1,250 discount. And so we know the discount amount is $1,250, and now we need to figure out what the discount rate was that they used to get to this $1,250. So we're going to divide that $1,250 by the full amount, which is 50,000. And then we're trying to get the discount rate for a 90-day note. And so we're going to take 360 divided by 90. And that's going to give us our 10%.
What would have been helpful there if they showed the total amount?
Yeah.
Because it would have been easier to get that, see that 10%, but because you have to do that 90-day and 360 calculation.
So this is going to be 0.025, and that's 4, and that equals 1. And then you're going to move your decimal over. It's 0.1, but then you're going to move your decimal over, and so that's going to give you your 10%. Because 0.1 is 0.1 or 10%. The journal entry to record the issuance of a note for the purpose of converting an existing account payable. So they're asking us, what journal entry would we use to record the issuance of a note to convert an existing account payable? So we have an account payable, and now we've taken a note out to convert that account payable. Debit accounts payable, credit cash. Is that what you said? It's going to actually be credit notes payable because we've issued, yeah, close though, very close, good, definitely a good guess. So we're going to debit our accounts payable and credit our notes payable to record the issuance of a note for the purpose of converting an existing account payable. Which of the following taxes are employers required to withhold from employees? So employers are required to withhold FICA. That's the one they're required to withhold.
The one like you can opt out of, I think both federal and state. I know federal, you can do it, depending on your status. You
Like if
can
you're
file
exempt.
Yeah, you can file exempt, depending on your status, like if you're a household, if you're a single, filing, get a house or stuff like that, that's your status. But then state tax, you can, I think you can also get out of that if you don't pay state tax for where the state that you're living in. Like if you live in Georgia, you file out of Tennessee, you don't pay any state tax. So they won't, you won't have to pay state tax. And then FICA, we just went over that, but I don't remember what it is, but I could see. Just to recap what it is.
Oh my gosh. Okay, so yeah, so FICA is the one that you're required to withhold. But it doesn't mean that you can get out of all the other ones. Like you have to legitimately be exempt from the other ones.
Yeah.
So which of the following is required to be withheld from employees' gross pay? So what are we required to keep from the employee's gross pay? Federal and state unemployment compensation, only federal unemployment, only federal income tax, or only state unemployment compensation tax? We are only federal income tax.
But you have to pay taxes on your earnings.
So which of the following is the most desirable quick ratio?
I can really see.
So we're talking about, so quick ratio. What is the most desirable quick ratio?
That's like how quickly they can turn your business into cash, like your assets into cash, right?
Yep.
So
that ratio you want to be
higher.
high. So the most desirable for out of all the options we have is the highest, which is 2.2. And that's because the quick ratio measures the company's capacity to pay its current liabilities without having to sell its inventory to obtain additional financing. Basically, you want the higher ratio for the quick ratio because it measures the liquidity and the financial health. The lower the ratio, the more likely the company would struggle to pay its debts, could potentially, not be able to cover their debts. So you want a high quick ratio. Based on the following data, what is the quick ratio rounded to 1 decimal point? So we're going to figure out we're going to calculate what our quick ratio is, and then we're going to round that to 1 decimal point. And the quick ratio measures our liquid assets. I hate the way this writes. Divided by current. Wow, that's terrible. Liabilities. Okay, I'm gonna have to tell you what this is, right? Because you cannot read it. So quick assets divided by your current liabilities. That's what we're looking at. So we need to identify out of all of these entries over here, which ones are quick assets, which ones are current liabilities, and we might even have some that don't fall in either of those categories. So first identify what your quick assets are, identify what your current liabilities are, and then we're going to divide those. So our quick assets, that's going to be our accounts receivable, our cash, our marketable securities. So accounts receivable, cash, marketable securities, those are all our quick assets. And then our accounts payable and our accrued liabilities, those are our current liabilities. So we're going to add those up. So we've got 60,000 plus the 30,000 and the 30,000, and that's going to give, and then they didn't total it out for us. But the 60,000 plus the 30,000 plus the 30,000, 120. Well, I'll write it down here. 60, 30, 30. And then we've got our 30,000 and our 5,000. So we're going to do 120. I guess they did, didn't they? I just didn't look that far. So they gave us our 120,000 divided by our 35,000, and that's going to give us a quick ratio of 3.4. So we know that this is the correct answer. So just note, make sure you know what your quick assets are, your current liabilities, to find your quick ratio. Intangible assets, intangible, those are things that are not quickly, they're hard to get. Inventory, you have to sell. It takes a little, when you're looking at these accounts, you're trying to figure out quick or liquidity. You know, inventory, you have to sell that inventory, so it's not really something that you can quickly convert to cash. Long term, we know anything long term is not going to be included in that because it's long term, so it's not quick and easy to convert. Fixed assets, you think of buildings, those are things that are hard to turn over into cash. And then prepaid expenses. So just try to kind of like go through these, and the first thing you want to do is identify, well, what's a quick asset, what's a current liability, and then go from there. Last one. So on August 1st, Batson Company issued a 60-day note with a face amount of $140,000 to Juergens Company for merchandise inventory. We're going to assume they have a 360-day year, and they want us to do two things. They want us to determine the proceeds of the note, assuming the note carries an interest rate of 6%, and then they want us to determine the proceeds of the note if it has a discount rate of 6%. So what we're doing here, so we're actually solving, sorry, I can totally see where that could be confusing. So first they're asking us to solve this problem. So determine the proceeds of the note, assuming the note carries an interest rate of 6%. So we have this note, two different, yeah. So we have this $140,000 note. And this first one, they're saying if it has an interest rate of 6%, what are the proceeds? And then and then question B is saying for this $140,000, trying to put a K for thousand. For this $140,000 note, they have a discount of 6%, and we want to figure out what the proceeds are of that.
It's like a reverse of the problem that we did earlier.
Yeah, so you've got, so basically you could have three different, they could ask you three different things. They could say, determine the proceeds of the note without an interest rate or a discount. And that would just, you know, you've got your 140 with interest, you've got, in this problem though, they're just asking, assume the note carries an interest rate, what is this? And assume you have a discount, what is that? So this might be tricky, but number one is just 140,000. We have Batson Company. They issued a 60-day note with a face amount of 140,000. Determine the proceeds of the note, assuming it carries an interest rate of 6%. But we just want to know. We want to know what the proceeds are. So the proceeds are 140,000 for this first one, for A. For B, we have a discount. So this is the one we have to calculate. So for B, they're saying we have a discount of 6%. So we're going to take that 140 times the 6%. It's a 60-day note. Sorry, you can't see my mouse. 140, 6%. It's a 60-day note over 360 days in a year. So that's gonna give us the discount amount, and then we're gonna take the face amount of the note minus the discount amount is gonna give us what the actual note amount is after we take out the discount, which is $138,600. So right here, this is where we calculated our discount amount. It'll be somewhere. You'll have something like this somewhere. That's why we're going over these things in class so that you have an idea of how to do them and work the problems and all that good stuff. Ask questions. All right, so that is the last practice problem for this chapter.